You just lost $5,000 in the market. Your stomach drops. Your heart races. You can't focus on anything else. And in that moment, you make a decision. You're going to win it back. Right now. You increase your position size. You take on more risk. You abandon your strategy. And you lose even more. This is revenge trading. And it destroys more accounts than bad market conditions ever could. Why? Because trading isn't about markets. It's about psychology. It's about managing your emotions when money is on the line. And most people can't do it. Professional traders know this. 90% of trading is mental. 10% is strategy. You can have the best system in the world, but if you can't control your emotions, you'll lose. Every single time. Because markets are designed to exploit human psychology. Fear, greed, FOMO, panic. Here's what happens. The market drops. Fear kicks in. You sell at the bottom. The market recovers. FOMO kicks in. You buy at the top. The market drops again. Panic. Sell again. This cycle repeats until your account is empty. You're not losing because the market is against you. You're losing because your emotions are controlling your decisions. The first rule of trading psychology is simple. Never trade with money you can't afford to lose. If losing this trade would devastate you financially or emotionally, you're trading with too much money. The moment you're scared, you've already lost. Because scared traders make terrible decisions. Think about Vegas. Nobody goes to a casino with their rent money. They go with entertainment money. Money they can afford to lose. Trading should be the same. If you're terrified of losing, you'll close winning positions too early and hold losing positions too long. Fear guarantees failure. Greed is just as dangerous. You're up $2,000. Your target was $1,000. But you don't take profits because you think it'll keep going. It doesn't. It reverses. Now, you're only up $500. Still don't take profits. It'll come back. It doesn't. Now, you're break even. Then negative. Greed turned a winner into a loser. The best traders have a plan before they enter any trade. They know exactly where they'll take profits, exactly where they'll cut losses, and they follow the plan no matter what. No exceptions. This removes emotion from the equation. You're executing a strategy. Stop losses are not optional. They're mandatory. Every single trade needs a stop-loss set before you enter. Not a mental stop, a hard stop. Because when the trade goes against you, you won't have the discipline to cut it manually. You'll hope, you'll wait, and you'll lose more than you planned. Here's a truth most traders learn the hard way. Your first loss is your smallest loss. When a trade goes bad, it rarely gets better. It usually gets worse. The sooner you accept the loss and move on, the less it costs you. But ego gets in the way. Position sizing is where most traders fail. They risk too much on each trade. Professional traders risk 1 to 2% of their account per trade. Maximum. Amateurs risk 10, 20, 50%. One bad trade and they're destroyed. You can survive 10 losses in a row at 1% risk. You can't survive even 2 losses at 50% risk. The math is brutal. Lose 50% of your account, and you need a 100% gain just to break even. Lose 75%, and you need a 300% gain. These are nearly impossible to achieve. Position sizing is survival. Overtrading kills accounts faster than bad strategies. You're bored. The market is quiet. So you take a trade you shouldn't. Then another. Each one chips away at your account. Professional traders wait. They're patient. They only take the highest probability setups. Amateurs trade constantly because they're addicted to the action. Trading is not gambling, but it becomes gambling when you trade based on emotion instead of strategy. When you enter without a plan, when you risk money You can't afford to lose. That's not trading. That's casino behavior. And the house always wins. Detachment is the ultimate skill. You need to care about your trading, but not too much. When you're too attached to the outcome, you make emotional decisions. When you're detached, you can execute your plan objectively. Think of yourself as a machine. You analyze, you enter, you manage, you exit. No emotion, no attachment, just execution. The trade either hits your target or your stop. Either way, you move to the next opportunity. Journaling every trade changes everything. Write down why you entered, what you were thinking, how you felt, what the outcome was. Over time, patterns emerge. You'll see that your best trades happen when you're calm and following your plan. Your worst trades happen when you're emotional. The market doesn't care about you. It doesn't care if you need to make money. It doesn't care about your bills or your dreams. The market just is. The sooner you accept this, the sooner you can trade rationally. Discipline beats intelligence in trading. You can be the smartest person in the room and still lose if you can't control your emotions. You can have average intelligence and succeed if you have iron discipline. Most traders blow up their accounts within the first year, not because they lack knowledge, because they lack emotional control. They know what to do. They just can't do it when money is on the line. So how do you develop trading psychology? Practice. Start small. Trade with amounts that don't make you emotional. Master yourself at that level. Then gradually increase. If you can't control your emotions with $100 at risk, you certainly can't with $10,000. The best traders are boring. They do the same thing every day. They follow the same process. They don't chase. They don't revenge trade. They just execute their edge over and over. And slowly, consistently, they build wealth.